Hi, I'm Jitesh from Trident and welcome to our winter energy market update. Today I'm going to talk to you through what's been happening in the energy market so far this winter, what's been driving prices, and what we're keeping a close eye on as we move through the rest of winter 2026. As always, we'll keep it practical and focused on what actually matters for your business. After the price declines we saw through summer 2025, that softer trend carried into the first half of winter. Gas and power prices across the forward curve from summer 2026 through to winter 2028 fell by around 14% for gas and just over 3% for power. But despite those overall declines, volatility hasn't gone away. Prices have been moving quickly and direction has largely been driven by a few key factors. Milder weather early in the winter reducing demand, strong and consistent supply from Norway, and record levels of liquefied natural gas exports helping to keep the market well supplied. That said, since the turn of the year, things have shifted. We've seen colder weather push demand higher than the 5-year average, carbon prices have hit record levels, and geopolitics once again move firmly back into focus. All of that has narrowed the forward curve, meaning the market has gone from a clear backwardation to a much tighter structure. And that's something we're watching very closely to see what effect that will have on the markets. Winter started on a fairly mild note, with temperatures through to the end of 2025 at or slightly above seasonal normal. That helped push prices down to the lowest levels since 2022. However, early 2026 marked a clear change. An Arctic blast swept across Europe, bringing sub-zero temperatures and putting pressure back on supply, which quickly fed through into higher prices. Looking ahead though, longer range forecasts suggest colder conditions could persist in February. With storage levels already being drawn down at a decent pace, any prolonged cold spell could tighten the market further and keep upside risk firmly on the table. On the wider weather picture, the La Niña weather cycle that sees cooler than normal sea temperatures is starting to weaken, but is still expected to influence conditions in the near term, meaning we're likely to see ongoing variability and chance of further cold spells through late winter and early spring. Further into 2026, a shift towards El Nino is expected, which typically brings milder and more stable conditions for the UK and Europe. That should reduce the risk of sustained cold, although short-term volatility and occasional extremes can't be ruled out. Recent colder weather has driven strong gas withdrawals across Europe, running at around 190 million cubic metres per day above the 5-year average. That's happened despite LNG send-out remaining strong, sitting around 11% above 3-year averages. What's interesting is that prices haven't reacted as aggressively as they might have in previous years. That reflects a looser global gas market and growing confidence in LNG supply, particularly with more capacity expected to come online this year. That said, risk hasn't disappeared. In mid-January we saw summer-winter spreads closer to parity for the first time since June. Simply put, winter prices are usually higher than summer prices because demand is higher in colder months. When that relationship flips and summer prices move above winter, it's a sign that the market is starting to worry about how much gas will be needed over the summer to refill storages. With storage levels now below the 50% mark, the market is pricing in risk that more supply will be needed later in the year. If colder conditions continue, that refill risk and the premium attached to it could build further. But as ever, Trident will be keeping a keen eye on what happens. The LNG market has been particularly interesting this winter. During the final quarter of 2025, both Asian and European front-month prices closed around 14% lower, driven by weaker demand in Asia at a time when LNG exports were hitting record levels. In contrast, US gas prices moved sharply higher, up around 55%, as colder weather boosted domestic demand, tightening balances just as feed gas demand was ramping up for LNG exports. During the first half of winter, 37% of US LNG exports were discharged into Northwest Europe, with the US supplying 65% of the region's LNG. Russian LNG deliveries stayed broadly unchanged from last year, underscoring Europe's continued dependence on US LNG as it plans to phase out Russian supplies by the end of 2026. Since the start of 2026, the price spread between Asia and European benchmarks has narrowed, with Europe holding a slight premium. Now that's kept an open arbitrage for US cargoes into Europe through to April. More recently, falling US prices, down nearly 30%, reflect uncertainty around new supply, with delays at key export facilities in the US, Australia and Canada, adding another layer of complexity and therefore a degree of uncertainty around pricing levels, meaning a keen risk management strategy would be advisable. Last year, front-month Brent oil recorded its largest annual decline since 2020, falling around 19%. That was driven by higher production from the US, OPEC and other producers, alongside weaker demand from Europe and parts of Asia. Looking ahead, forecasts suggest global supply growth to continue to outpace demand, but geopolitics remains a key source of volatility. Tensions involving Iran have supported recent price moves, while potential changes in US-Venezuela relations could impact supply longer term, although meaningful increases would require significant investment and time. Alongside this, ongoing geopolitical trade tensions between the US and Europe have reintroduced uncertainty, which can quickly feed into wider market volatility. Carbon markets have also been a major story. Both EU and UK carbon prices hit record highs last year, and that momentum has continued into 2026. Prices have been supported by tighter supply, lower auction volumes, and more restrictive emissions cap under the EU Green Deal. More recently, the European Parliament Committee voted in favour to provisionally reduce greenhouse gas emissions by 90% compared to 1990 levels, whereby Parliament plenary for final approval will be held in February. Options positioning suggests the market is anticipating further price increases, which continues to provide underlying support, particularly as higher carbon prices directly influence power generation costs. While prices have stabilised somewhat in recent months, the mix of weather, LNG flows, gas storage levels, and geopolitics means volatility can quickly return. If you're on a flexible contract, a clear risk management strategy can help you take advantage of when opportunities arise, while protecting your businesses from sudden price spikes. And if you've got a fixed contract starting in 2026, now is a good time to be engaging with the market. When volatility picks up, opportunities can disappear fast. If you've got any questions, we're always happy to help, and you can also head into the Insights section of our website for more market updates and practical guidance. I'm Jitesh Panchal, and thanks for watching.